Welcome to the deep dive. We're putting on our gear today to explore what's really churning beneath the surface of the financial markets.
Definitely feels like choppy seas out there.
It really does. And, funny enough, that lines up perfectly with the title of the piece we're digging into today, Macro Butler's Sailing in Tariff Shock.
Ah, yes. You flag this one. It's quite the read. Really cuts through a lot of the noise, doesn't it?
It does.
It tackles the latest inflation numbers, sure, but maybe more importantly for everyone listening, it looks at the potential impact of these new tariffs, the ones just enacted and the ones still being talked about.
Exactly. Because let's be real, if you're listening, you're probably an investor, or at least keen on the economy. You want more than just headlines.
You want to know what it means for your money.
Precisely.
Yeah.
What does this all mean for your financial future? So that's our mission today. We're using Macro Butler's insights from that Sailing in Tariff Shock piece as our guide,
Trying to find some clarity in the storm.
hopefully providing some actionable insights. Okay, so let's start with the latest inflation picture, the March CPI data. This is kind of the before snapshot, right? Before the tariffs really hit.
That's the key point Macro Butler makes. But yeah, looking at March itself, it actually looked a bit calmer on the surface.
A little bit. We saw that minus 0.1% month-on-month figure. First actual monthly deflation since, what, May 2020?
Yeah, quite a while back. And year-on-year, CPI slowed down too, came in at plus 2.4%. That was lower than forecasts.
So what was driving that dip?
Well, the main factor was energy. Energy prices took a dive, pulling the headline number down.
Okay, but it wasn't all good news, was it?
No, never is it? Core goods, they were still technically in deflation, but the pace slowed. And wouldn't you know it, food prices actually picked up speed.
Ah, food, always the wild card.
Yeah.
Now, what about core CPI? So stripping out food and energy.
Right, the Fed watches this closely. It was up, but only just. Plus 0.1% month-on-month, also a bit below what people expected.
And year on year?
Plus 2.8%. That's actually the lowest reading since March 2021.
Sounds good, right?
It sounds okay, but Macro Butler adds some context there, doesn't he?
He does. He points out that, yeah, it's lower, but it's still the 58th month in a row we've seen an increase. 58.
Wow, that's persistent. And digging even deeper, there were still some sticky spots. Owner's equivalent rent, OER.
Still stubbornly high. Yeah, 4.4% year on year. That housing component just doesn't want to cooperate.
It really doesn't.
Look.
But then there's this other measure, supercore CPI. Remind us what that is again?
So Supercore takes core services, but then it strips out housing costs, trying to get an even cleaner look at underlying service inflation.
And how did that look?
Actually, a bit more encouraging. It dropped to 2.86% year on year, lowest since December 2021.
Okay, so that's better.
It is, but, and this is the crucial but Macro Butler highlights, even 2.86% is still, quite a bit above the Fed's 2% target.
Right, so not out of the woods by any stretch. Now, how did the markets take all this slightly confusing data? Yeah, confusing is a good word. Macro Butler described the reaction as a bit terrified.
Terrified. I like that.
Yeah. Initially, stocks tried to rally a bit on the cooler numbers, but then they kind of faded, especially growth sectors like tech and also energy.
Interesting. So what did well?
More defensive areas, things like consumer staples, utilities. It was like a brief sigh of relief followed by a, wait a minute, moment.
A bit of risk off creeping back in. And what about expectations for the Fed? Does this change anything?
Oh, yeah. The rate cut talk definitely got louder. The market started pricing in like almost 4 cuts by the end of the year.
4 cuts. Wow. And maybe the first one soon?
Potentially June. Yeah, that's what the pricing suggests. And you saw the dollar sell off a bit too.
Makes sense. And goals.
Gold loved it. Or maybe he just loves the uncertainty. Flew to a new all-time high.
Classic gold move. But here's the weird part, right? The 10-year Treasury yield actually went up, despite softer CPI.
Exactly. Seems counterintuitive, doesn't it?
It does. What's the thinking there?
Well, Macro Butler suggests this might be the bond market already starting to look past the March data and beginning to price in, or at least worry about, the inflationary impact of these tariffs.
Ah, okay. Which brings us squarely to the main thrust of his piece, this looming tariff shock.
Precisely. He's very clear that March CPI data, it's old news in a way. It doesn't reflect what's coming.
And he uses some pretty dramatic language, right? Liberation Day tariffs. The April 2 tariff bazooka.
He certainly does. He's painting a picture of a pretty significant policy shift.
So break down the scale for us. What are we actually talking about here?
We're talking about the effective tariff rate on, get this, $450 billion worth of Chinese imports jumping to 30%. 30%.
Oof, that's a big jump.
And then there was that additional spike planned for April. Now, that got sort of paused for most countries, but it seems locked in at a pretty high level specifically for China.
So this isn't just tinkering around the edges.
Not according to Macro Butler. He thinks the consequences are likely higher prices. For consumers, for businesses,
Yeah.
on lots of everyday things.
Like what? Does he give examples?
Yeah, he mentioned stuff like kitchenware, toys, clothes, phones, things where actually you could already see some minor tariff effects in the March data. He's saying expect more of that, potentially a lot more.
Okay, so costs going up. And he introduces this term Trump reflation.
Yeah.
What's the core question there?
The big question is, who pays? Do businesses just absorb these higher tariff costs, squeezing their margins? Or do they pass them straight through to consumers?
Which means higher prices for us.
Exactly. That's the multi-billion-dollar uncertainty right now.
And it's not just goods, right? He mentioned services, too.
Yeah, another potential factor he throws in is tighter immigration policies. If that restricts labor supply in certain service sectors, you could see wages pushed up and then service prices follow.
So, potential inflation pressure from multiple angles. And he has this umbrella inflation index.
Right. It's like an average of various inflation measures. And he points out it's currently sitting around 3.26% year on year.
Which is still quite a bit higher than 2%.
Way higher. So, yeah, his whole point is that this idea we've conquered inflation or that it's heading smoothly back to 2%, he's skeptical. Very skeptical.
Which leads him to challenge that whole narrative, right? The idea we'll hit 2% inflation by year end.
Yeah, he basically does the math.
Yeah.
And it's pretty stark.
How stark?
To get down to 2% year on year by December, monthly CPI increases would need to average less than 0.1% from here on out.
Less than 0.1% per month.
Yeah. He calls that a statistical unicorn. Highly unlikely, basically.
Given tariffs and everything else.
Yeah.
Yeah, seems like a long shot.
And on the flip side, if monthly increases average just 0.2%, which seems way more plausible, frankly, year-end CPI would be closer to 3%.
And if it's higher than 0.2%.
Well, then the numbers get uglier. He shows that even moderate monthly increases could push year-end CPI well above 3%, potentially even towards like 5 or 6% in a bad scenario.
Yikes. Okay, so that puts the Fed in a really awkward spot, doesn't it?
Totally. The market's yelling for rate cuts, but if inflation stays sticky or even reaccelerates because of these tariffs, what do?
They might have to backtrack on cuts or even hike again. That would not go down well.
No kidding. Macro Butler calls it a potential partisan policy limbo contest. It's a tough balancing act.
Okay, let's shift gears slightly. One justification often used for tariffs is that they help reduce the trade deficit. What's Macro Butler's take on that?
He pretty much debunks it. He points to the experience from 2016 to 2020. Tariffs went up on lots of goods.
And the trade deficit.
Barely budged. It stayed stubbornly wide right up until the pandemic really hit and scrambled everything. So the idea that tariffs automatically shrink the deficit, recent history doesn't really back that up.
So if it's not tariffs, what does drive the trade balance, according to him?
He argues it's much more about the overall health and wealth of the economy. A richer country tends to buy more stuff, including imports. It's less about the barriers and more about underlying economic factors.
That makes intuitive sense. Does he link this to inflation or market signals?
He does. He notes, interestingly, that periods where the U.S. trade balance has improved have often coincided with a slowdown in CPI inflation. Not necessarily cause and effect, but a correlation.
Okay, and he brings in some market ratios too, right? Like the gold to bond ratio.
Yeah, this is fascinating. He points out that historically, when the price of gold rises significantly relative to the price of bonds, the gold to bond ratio breaks above its long-term average, it often signals an acceleration in the U.S. trade deficit.
Huh. Why would that be?
It might reflect growing economic uncertainty, maybe concerns about government debt, things that make investors favor gold over bonds. And those same underlying issues might also be driving a wider trade deficit.
Interesting. And what about the S&P 500 to oil ratio?
That one, he says, can signal the opposite. When the S&P 500 falls relative to the price of oil below its long-term average, it can sometimes precede an improvement in the trade deficit.
How does that work?
The thinking might be a weaker economy drags down stock prices relative to oil, and a weaker economy also imports less, including oil, which helps the trade balance. It's complex, but these ratios offer clues.
Right. Gauges on the dashboard. And he mentions the S&P 500 to gold ratio as well. It's something about monetary illusion.
Yeah, monetary illusion, basically, focusing on dollar amounts instead of real inflation-adjusted value. He sees the S&P 500 to gold ratio as an indicator here, and he links a breakdown in the U.S. trade balance below its long-term average to this illusion spreading, potentially signaling a shift from boom to bust.
Okay, so if tariffs aren't the main driver of the trade deficit, what does Macro Butler think is?
His core argument is structural. He believes the long-term expansion of the U.S. trade deficit is largely down to U.S. companies moving production overseas,
Why?
seeking lower costs, fewer regulations, maybe better tax environments abroad. He even shows a negative correlation when corporate profitability expectations rise. The trade deficit tends to worsen, suggesting companies are profiting from that overseas production, which drives imports.
That makes sense. And he even made that slightly counterintuitive point about inflation potentially helping corporate profits.
Yeah, because companies often have pricing power. They can pass on higher input costs, fueled by inflation, to customers. So top-line revenue grows, and if they manage costs well, profits can hold up or even rise, at least for a while.
So summing up his view on tariffs, they don't really fix the trade deficit. They might make inflation worse. What's the fundamental flaw he sees?
He thinks the old textbook theories about tariffs, inflation, currency manipulation, they just don't fit the modern, interconnected global economy very well.
So what does cause inflation, in his view?
He boils it down to three things: real shortages of goods or services, excessive overall demand, or crucially, a lack of confidence in the economic future.
And how do tariffs play into those?
Well, he argues they can actually make all three worse. Tariffs directly raise import costs, potentially creating shortages or higher prices for industries relying on those imports. They disrupt supply chains. They can distort demand signals. And maybe most importantly, they create uncertainty. They damage international relationships, which erodes confidence.
Plus, they don't account for things like currency fluctuations or capital flows, right?
Exactly. A tariff is a blunt instrument. The exchange rate might adjust or capital might flow differently, completely offsetting or altering the intended effect of the tariff. It's just not that simple.
And the direct impact is just higher costs for importers.
Yep. Which hurts industries that rely on those imports. That can mean higher production costs for them, maybe job losses in those sectors, and ultimately higher prices passed on to consumers. It's a chain reaction.
He also mentioned something about mercantilist free trade and trust.
Yeah, his point is that global trade relies on a degree of mutual trust and reciprocity. Slapping on tariffs can be seen as breaking that trust, leading other countries to retaliate, and you end up in a trade war spiral where pretty much everyone loses.
And there are geopolitical ripples, too. He mentioned Russia, China, India, the Valerie Pires Circle.
Yeah, the Valerie Pires Circle, it's a term for that huge population concentration in Asia. His argument, and it's a provocative one, is that U.S. policies like tariffs might inadvertently be pushing major powers like Russia, China, and India closer together, forming a powerful economic bloc that could challenge the U.S.
That's quite a thought. He contrasts U.S. actions now with past aid efforts.
He does. He points to the difference between, say, the global aid response after the 2004 tsunami versus imposing tariffs on Myanmar after a recent earthquake there, suggesting a potential shift away from cooperation towards more confrontational economic policies.
Okay, so given this rather challenging outlook painted by Macro Butler, this tariff shock scenario, what's the advice for investors? How do we navigate this?
His recommendations are pretty clear and lean towards caution and protecting against inflation. First, in stocks, he favors quality. Low leverage companies, strong balance sheets, consistent EPS, and free cash flow growth.
So financially sound businesses, any specific sectors?
He specifically suggests favoring energy producers over energy consumers, basically betting that energy prices might stay high or go higher and consumers will feel the pinch.
Okay, that makes sense in an inflationary world. What about bonds? Fixed income?
He's very wary of long-term government bonds. Like anything beyond 6 months maturity, he'd avoid. The risk of inflation eroding their value is too high in his view.
So what do you do with that part of your portfolio?
He suggests actively managing cash, maybe using short-term investment-grade corporate bonds for a bit of yield, but maintaining flexibility.
And then he makes a really strong call on hard assets, doesn't he?
Oh, yeah. This is probably his boldest call. He recommends taking a significant chunk, he says, over 25% out of long-term bonds and putting it into physical gold, silver, and potentially other hard commodities.
25% plus. That's a big allocation. Why?
He sees them as anti-fragile, meaning they don't just survive turmoil, they can potentially benefit from it.
Yeah.
He views them as essential protection against persistent structural inflation and also the risk of a sovereign debt crisis down the line.
A hedge against the system breaking almost.
Kind of. He explicitly calls gold and silver hedges against collective stupidity and government overreach. Pretty strong words.
Indeed. So overall, expect more bumps in the road.
Definitely. He warns investors, prepare for higher volatility and don't expect amazing returns after inflation is factored in. It could be a period of dull, inflation-adjusted performance for traditional portfolios.
And he's watching that S&P 500 to gold ratio as a warning sign.
Yes. If that ratio breaks below its 7-year moving average and stays there for, say, more than a couple of months, he sees that as a signal that we might be shifting from this inflationary boom we've sort of been in towards an inflationary bust.
Stagflation, basically.
Exactly. Slow growth, high inflation. And he warns that could arrive within maybe 6 to 9 months after that signal flashes.
And that would be particularly painful for.
For investors still holding on to those long-dated bonds thinking they're safe, stagflation would likely hammer those, whereas he believes assets like physical gold could perform well in that scenario.
So bring it all together then. The March CPI was just a snapshot. The real story, according to Macro Butler's sailing and tariff shock, is the incoming wave of tariffs and the potential for Trump stagflation.
That's the core message. For investors listening, the key takeaways are: brace for potentially higher, stickier inflation. Don't assume tariffs will fix the trade deficit. They might make things worse. And consider shifting strategy towards quality companies, energy producers, keeping bond duration very short, and importantly, building a significant position in hard assets like gold and silver as a hedge.
Okay, so here's a final thought for everyone listening to mull over. Macro Butler highlights these historical links: trade balance and inflation, gold to bonds, S&P to gold. Thinking about those, what specific indicators are you going to watch most closely now?
Is it the monthly CPI print? Or maybe the trade figures themselves? Or are you going to track those market ratios, like the S&P to gold, looking for that potential stagflation signal he mentioned?
Yeah, it really prompts you to think about which signals matter most in this environment. It's probably worth digging into those indicators yourself and considering how this tariff situation might reshape the whole economic picture.
Absolutely. It's clear that navigating these tariff shock waves isn't going to be straightforward. It requires being informed, being proactive. Hopefully, this deep dive gave you a framework for thinking about the risks and maybe some potential opportunities, too.